Welcome back to Investing Talk Podcast.
Today we're looking at Iamgold.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. And, we are diving into a company that I think many listeners might have previously seen as just a mid-tier player, kind of fighting for scale.
Right. But something has clearly changed.
It has. They've recently shown these really clear markers of a major turnaround story. The Q3 2025 earnings report was the proof point the market really needed.
Proof point is the right way to frame it.
Yeah.
Because when we talk about a turnaround, you need concrete evidence, right? Something operational, not just a cyclical bump from higher gold prices.
Exactly.
So let's unpack this. Just how significant was the actual earnings beat in Q3?
It was dramatic, and it really signaled some serious efficiency improvements. The adjusted net earnings per share came in at 30 cents.
30 cents. And to give that some context, what was the street expecting?
The street consensus, what analysts were broadly looking for, was only 21 cents.
Wow.
So that's a massive outperformance, nearly 43% above what was expected. Their net earnings per share followed suit, posting 24 cents. This isn't just good. It shows the company is successfully translating production into, clear shareholder value.
A 43% beat on the bottom line is excellent.
Yeah.
But that only holds up if the top line is robust and sustainable.
Mm-hmm.
How did the revenue figures look?
The revenue was definitely strong, and it reinforces that operational thesis. Q3 2025 revenues hit $706.7 million.
And that's a jump from the previous year.
A significant jump. If you look at Q3 2024, revenues were closer to $439 million. Now, to your point about macro conditions, yes, they leveraged those beautifully. This result was supported by selling 203,000 ounces of gold.
At what price?
At a very, very healthy average realized price of $3,492 per ounce.
Wow. Realizing nearly 3,500 an ounce is impressive. That's the kind of margin that fuels serious profitability.
Exactly. And that is why the growth in gross profit is what analysts are really keying into right now. Gross profit grew substantially to $272.6 million in Q3.
That kind of margin expansion in a single quarter is often a signal that operational efficiency is kicking in at the same time as that favorable pricing.
That's it. Which brings us to the crucial component for any gold miner costs.
Right. We always want to know if management is keeping a tight lid on expenses, especially when they're expanding. So what are the key cost metrics telling us?
They are managing costs, and their revised guidance gives investors comfort about forward profitability. We look at two main metrics. First, their annual cash cost. That's between $3,375 and $1,475 per ounce.
Okay, but the more important one is the all-in sustaining cost, the AISC.
Yes. For our listeners who might not track miners every day, the AISC is so much more important.
Can you explain why that is?
Well, AISC gives you the true cost of staying in business. It includes pulling the gold out, plus all the capital to maintain the mine, keep it safe, exploration, corporate overhead. It's the whole recurring cost.
The full picture.
The full picture. And their guidance for AISC is pegged at $1,830 to $1,930 per ounce. So when you compare that range to their realized gold price of nearly $3,500, you see just how healthy those margins are.
That context is incredibly important. If their AISC is below $2,000, that's a very comfortable operating margin, especially with gold prices where they are.
And that visibility on cost control helps explain why the forward outlook is so bright. We're seeing some high-end analyst projections for their full-year 2025 EPS getting up to $0.89.
Those upward revisions are crucial. It suggests the market sees this Q3 performance as the new baseline, not a one-off.
And that sustainable performance is completely supported by their financial structure. Let's dig into that balance sheet a bit.
A growth company needs flexibility. So what does their capital structure look like?
Flexibility is the key word. They have a very lean debt profile, which is absolutely critical for a company looking to reinvest. Their debt-to-equity ratio is only 0.27.
So very low.
Incredibly low. I mean, anything below 1 means you're financed more by equity than debt. A 0.27 ratio suggests they are highly resilient to financial shocks.
A huge advantage. And what about their short-term health? Their ability to cover immediate expenses?
That's where the current ratio comes in. It's strong at 1.68. But the real story here is the company's powerful cash generation. Net cash from operating activities hit an impressive $280.8 million
In Q3 alone.
in Q3 alone.
That's excellent, but it's free cash flow that truly matters, right? That's the money they can actually use for growth.
Precisely. And we saw significant free cash flow strength there, specifically $135.6 million in mine site free cash flow just at their key operations.
So if you connect this to the bigger picture.
Their trailing 12-month adjusted EBITDA has now surpassed $1 billion. This scale of consistent cash generation is the engine that lets them fund their big strategic moves, which brings us to their competitive edge.
Right, the natural progression. When a company generates that much cash, the next question is always, where are you putting that money?
Right.
So let's talk about their core assets.
Their moat is built on asset quality and jurisdictional stability. They hold high-quality Tier 1 assets. We're talking large, low-cost, long-life projects.
Where are they located?
They've got 100% of the Westwood project in Quebec, a strong 60% stake in the critical Côté Gold project in Ontario, and then 90% in Essakane. Those Canadian assets really anchor their production in some of the most stable mining jurisdictions in the world.
But the strategy isn't just about holding assets. It's about expansion. The move to consolidate resources is what really sets them apart. Tell us about the Nelligan expansion.
This is where the story shifts from just a simple earnings beat to a long-term strategic transformation. They executed key acquisitions, Northern Superior Resources and Mines du Orbec, and it was all focused on expanding the Nelligan mining complex.
And what's fascinating here is that this wasn't just about buying up more ounces in the ground. It was about locking down a huge piece of land.
Absolutely. This consolidation was protectionist and strategic. By merging these holdings, they've essentially doubled their land holdings in these high-potential Canadian districts. This move transforms Nelligan into one of Canada's largest pre-development gold projects.
So this scale protects them against smaller competitors.
Exactly. It prevents claim fragmentation and ensures future cost advantages from having centralized infrastructure.
So if the Q3 beat was the proof point, the Nelligan expansion is the strategy. It's the pivot from being a collection of mines to being a focused, integrated mid-tier leader.
That's the perfect way to put it. And the market is starting to validate this. I mean, the technical signals right now are confirming a really solid uptrend.
How does the chart look? We know the stock has been trading near its 52-week high, which for some investors suggests the easy money might already be made.
It did hit a new 52-week high, yeah, but it suggests a strong accumulation to breakout pattern. The technical setup is textbook bullish. The stock is trading clearly above both its key averages. The 50-day moving average, around $13.69, and the 200-day, which is down at $10.47.
And when that shorter-term average, the 50-day, moves above the longer-term 200-day, that's the signal technical traders are looking for, correct?
That it confirms the famed golden cross, which signals a sustained long-term bullish trend. Now, to your point about the easy money being made, this is where valuation becomes so important.
Okay.
While the price is moving up, the metrics suggest that relative to its future growth, there is still room to run.
I see you're looking at the PEG ratio. For the listener, why is the PEG ratio, 0.43 in this case, a better measure of value here than just the PE ratio, which is sitting at 27?
That's a great question. The PEG ratio, the price to earnings divided by the expected growth rate, is the essential tool for spotting growth at a reasonable price. A PE of 27 can look expensive on its own.
Sure.
But when you factor in the high expected growth from the Nelligan strategy, the resulting PEG of 0.43 is well below that benchmark of 1.0. It suggests the market hasn't fully priced in the future production growth yet.
That makes the $19 price target from CIBC sound a little less outlandish then. They must be modeling that growth pretty aggressively.
Exactly. The fundamental story is providing the justification for that technical momentum. And shifting to sentiment, the immediate market mood is overwhelmingly bullish, driven by analyst upgrades. The consensus is a moderate buy.
Can we look at the range of those targets? Because that tells us how much disagreement there is.
Certainly. The average price target is $15.25. The high end, as we mentioned, is $19 from CIBC. Scotiabank is at $15, and Raymond James is a bit more conservative at $13. But the key is that the general movement is all upward.
And it seems the money is flowing that way, too. We've seen evidence of institutional accumulation in recent 13F filings.
A powerful vote of confidence. And we can't ignore the speculative catalysts, especially when a company is actively consolidating like this.
What are we hearing on the rumor mill?
Well, there's unconfirmed chatter about potential further M&A activity in those Canadian gold districts. The thesis is simple. By becoming one of the largest pre-development players, the company itself becomes a much more attractive takeover target for a global major.
A ready-made package for someone looking for Tier 1 exposure in a safe jurisdiction.
You got it. And that anticipation can fuel the share price.
Okay, that's certainly something to monitor.
Yeah.
Now, we've laid out the bullish case, but we have to address the bear case. What are the material risks here?
The bears are focused on two things. First, on the financial side. Despite the huge earnings beat, Q3 revenue actually missed the consensus expectation just slightly.
Oh,
It came in at $706.7 million versus an expected $714.6 million. Management said it was mainly due to gold prepay impacts and working capital swings. So it's more of a technical miss, but it gives skeptics something to point to.
that seems minor given the EPS performance. What's the more material risk?
The undeniable material risk is geopolitical exposure, specifically at the Essakane operation in Burkina Faso. While their Canadian assets are top tier, Essakane provides a significant chunk of current production.
And any instability in that region is a very real risk.
A very real risk to operations, to costs, to sentiment. It's an unavoidable factor.
So if that risk is so material, why isn't the stock trading at a bigger discount? How are they mitigating it?
The market seems to feel these risks are largely priced in, or at least that they're manageable because of the company's financial strength. We go right back to the balance sheet. Their strong free cash flow and incredibly low debt provide a crucial cushion to absorb potential shocks.
Okay, so looking forward, what's on the catalyst calendar for the next 3 months?
The main thing will be the Q4 2025 results, which we expect in early February 2026. The market will be watching to see if that cost structure from Q3 is maintained. Beyond that, look for updates on the Nelligan integration at industry conferences.
And tying back to the macro environment, the stock is also benefiting from some powerful tailwinds right now.
Absolutely. The whole gold sector is getting a lift from expectations of future rate cuts. And since the stock is already trading near its 52-week highs, that gold price tailwind acts like an amplifier on its existing momentum.
So what does this all mean for the listener? Let's tie this all together. What's the investment thesis here?
The core thesis really rests on three pillars. The Q3 earnings beat prove they can operate efficiently. The Nelligan expansions establish them as a credible, large-scale, mid-tier leader. And finally, the strong balance sheet and bullish technicals validate this whole shift.
And even though it's near 52-week highs, that PEG ratio suggests it's still growth at a reasonable price.
It does. The company appears set for a multi-year hold, leveraging its self-funded growth into those Canadian assets. This combination of fundamental strength and strategic growth is what makes this so compelling.
So what's left for you to decide is whether those high-quality assets and low debt outweigh the inherent geopolitical risks. It's a risk-reward equation that seems to be tipping more and more toward reward.
It really is. And if you want more analysis like this in your feed every week, make sure you hit that subscribe button. We'll catch you next time.